Hello. Wonderful to be here. And congratulations to Aspen for this amazing thought-provoking day. Our panel is going to talk about money. Money is helpful. That's why people invented it long ago. It solves problems for us, but it doesn't solve all the problems that we sometimes wish that it could, and it also causes problems. And that's why people have been reinventing it for thousands of years, from the time we had shells and pebbles to precious metals to coins to paper to plastic to electrons. A lot of us feel that we may be on the precipice of a new reinvention of money, and that it could be incredibly impactful, as have all the other reinventions. They've all tended to spread access, economic progress, growth, ability for people to participate in the economy, which is what our program is about today. So we have two amazing experts here to talk with us about the advent of cryptocurrency and especially stable coins. And Jen, I'm going to start with you to just level set, because I think we have an audience here that isn't living and breathing stable coins. And we're talking about infrastructure, and people with infrastructure sort of picture physical things or perhaps broadband or so on, but they don't think about money as infrastructure. Tell us what is happening in this space that's so significant.
Great, thank you, Joanne. Hi, everyone. It's lovely to be here. I'm very excited to be here and have this conversation in particular. Just a quick background for me, which I think will help you have some perspective around how I'm approaching this. I work for Standard Chartered Bank. We're a UK-based bank. We operate in 54 markets. Most of those markets are emerging economy markets, so Middle East, Asia, Africa, etc. We're over 150 years old, but for the past 10 years have been a GSIB that's been participating in investments and offering client capabilities in crypto or digital asset options. So what is happening, I think, to have that conversation, to answer that question, the first thing is to define the terms that we're using today. So we've already used crypto, we've used digital asset, we've used stablecoin. What are they? Are they the same? Are they different? For the purposes of this conversation, we're talking about stablecoins today. If I deviate from that, if I say crypto and I don't mean a stablecoin, I will explicitly say what type of cryptocurrency I'm talking about. Stablecoins are a form of crypto asset, and what's unique about them is that, different from today, when you move a stablecoin from an account to account, it can be peer-to-peer, and you're moving the value and the ownership of that asset when you move the token itself. Something that might be helpful in grounding our discussion, and we talked a little bit about this already, is how is it different than what we have today? And Biz and I were just having this conversation of who actually feels what when crypto becomes mainstream, or even as it's starting to become mainstream. And I think this is where it's really important to call out that in these early days, what you will see, particularly from a peer-to-peer perspective, the real tangible impact of stablecoins is going to be in those emerging markets, and that's going to be because they have very volatile domestic payment systems or local currencies, and they don't have strong financial infrastructure. Here in the U.S., we have relatively accessible financial payment options. One of which that we probably all kind of use today would be a PayPal or a Venmo. These are peer-to-peer payment systems. And what they did when they first came out is they made the ability to make a payment instant and social, right? Super fun. I think sometimes I'm horrified when I see my kids on Venmo with all their exposed transactions, but privacy takes on different definitions for different people. So how is that different, right, with stablecoins and the systems that are being built today? The Venmos, the PayPals, that really was about the user experience, and it was a user experience, I think, evolution in this country. What we're looking at today with stablecoins is not having necessarily that user front where the payment transfer still happens, but the back end is still relying on ACH or payment debit systems or clearing and settlement processes that have always existed. With stablecoin transfer, because the value and the ownership transfers at the same time, it is actually instant. And what that means is that the infrastructure that's moving the money is what is changing. It's not necessarily the user experience, but that underlying infrastructure. So hopefully that's helpful as we continue to talk today. And I don't know, Biz, if you have any other.
No, I think you covered it well. I think you couldn't have said it better.
So we just had a law passed in the United States, the Genius Act, which for the first time creates a legal framework around how stablecoins can be used and who can issue them. You both represent very large international banks. Biz, you have corporate clients, large bank clients. What are they thinking about as they look at the opportunities that are opening up here?
So, Joanne, I'll pick up from where Jennifer left off. We have a similar profile as Standard Chartered at Citi. We're in close to 100 countries, but where we differ a little bit is most of our client base, like you said, are large multinational corporates, FIs, banks, asset managers. And going back to your mention of the Genius Act, actually starts the process in terms of the legislative coverage. It's covering people who issue stablecoins. I think, and we're very hopeful that you need a little more advancements in legislation and regulation to cover the users of stablecoins and other crypto assets, because the Genius Act also doesn't cover crypto assets like Bitcoin that people are using for trading. But for us, our North Star at Citi is always based on our clients' needs, right? How are their commercial models changing? When and how are their needs for money? And this is where we start to differentiate between instruments like coins versus money. Because money, and you mentioned earlier, exists as a store of value. It exists as a means of making loans, credit, funding. And that's what we see from our clients, the large corporates, large multinationals, the banks. They're all looking at money as interchangeable instruments. So for us, when we talk to our clients, we're asking them, what do you need? They're like, we need payment services, obviously. We need funding, we need financing, we need borrowing, we need liquidity, all of these things. And so as a bank, we look to see how their needs are changing, when those needs are becoming instant, when those needs are becoming 24/7. And then we try to figure out the best instrument possible and how those instruments operate. Because you don't want very efficient instruments that do one thing really well, but then aren't interoperable or fungible with other forms of money. So we're still in early stages, as we see from the evolution of the crypto asset, the coin, and the client kind of needs to look which way these things are heading. So our focus continues to be working with clients, managing their forward needs, and there are certainly cases where they are looking at not just the instruments themselves, but the blockchain technology, and trying to figure out other efficiencies for the technology, because the technology works 24/7. So it has a lot of benefits for digital data processing if you just leave money aside. And then we look at the money and the various forms of instruments that are coming up under the regulatory umbrella to see how these fit. And ultimately, as individuals, as we travel around the world, you want to be able to use your money seamlessly. You don't want to end up somewhere where they're like, we don't accept this form of money, we want that form of money. And as you transfer money across forms, you end up losing value.
Can I add one
Yeah,
thing to that that's really cool? Because sometimes I think it was like, regulation, and people start to fall asleep. What was really cool about Genius are two things. One is, at Standard Chartered, we've been banking stablecoin companies for a while now. And to be able to do that, we really had to go quite conservative on, our due diligence with the client, our risk appetite, and our risk frameworks, et cetera. What Genius did was it codified what the requirements requirements are in terms of transparency, auditability, and made it a much safer and clearly supervised activity for banks to be able to participate in, which from a safety and soundness perspective is critical when we're thinking about the global financial system. So that's one. The other thing that's really cool is having worked in the regulatory environment before, it's really, really hard to do iterative rulemaking or iterative regulatory process. And what I mean by that is once something is released, a lot of times it's really, really hard to go back and change it. What we saw with Genius, if you did a line-by-line comparison with MiCA, which is the European stablecoin first take at a licensing regime, is that about, I'd say, finger to the wind, 70-75% of Genius reflected what was already in MiCA and then built upon it. And now what we're seeing are in regions where there was already regulatory framework, Europe, Singapore, et cetera, they're going back to Genius and saying, okay, what's the policy gap, and do we want to get there? Do we want to improve and add to ours? That is a fantastic way and a very fast-moving environment to keep up with the technology changes and try to create harmony between regulation. I think it's one of the first times I've seen it done, and I thought it was a really smart way to tackle the legislation.
Yeah, I'm a former regulator as well. Iterative regulation is like a total oxymoron in the traditional system. So there's a school of thought. So you may agree or disagree. There's a lot of hype in this space, as there is in AI. These are, in the financial world, these are the two transformative technologies that, in my view, are converging on us, and the combination of them is changing everything. The potential for really seeing a blossoming of AI agents in payments so that you can, as an individual or a company, will be able to authorize an agent to figure out what your financial transaction should be and do it for you. The people who are working on those kinds of issues are thinking in terms of stablecoins as the medium to use for payments, partly because they make money programmable. You get out the friction and the sludge in the system, if I can call it that, by being able to get efficiency. So my question for both of you is, what do you think of the hope that this new technology is going to create a whole new payments infrastructure layer that can massively decrease the costs of the system, massively decrease the friction and slowness of payments, and also potentially, and I'd love to know what you think about it, also make the system safer? Or is it going to make it more dangerous?
So Joan, if I can just pick on what you're saying, and I'd like to broaden it a little more than beyond just payments. Right? Like I said, yep. The technology and the instruments allow for a lot of functionality. And at Citi, we did our own version of a coin or a token, which has been up and running now commercially. It's called a Citi token. It works for our clients. It operates on an internal blockchain network. It uses the same technology components that coins use. And what we're already seeing is the benefit that you're talking about, because a lot of our clients that are multinational operate, subsidiaries in different time zones. In the past, they were restricted by cutoff time. So if they were in New York and they had to move money to their Asia, operations, they would have to do it the previous night so that Asia, when they came in the morning, could use it.
Which means they're carrying risk, exposure during that time period, which adds cost, doesn't it, to the system?
And then you also have issues where holiday calendars don't match up. So so we've been live with our internal token, which is available to any Citi client on a corporate basis to use, and we're already seeing them use concepts of rule-based common liquidity pooling. So you can add, to your point, rules or program in there saying if you have multiple accounts and one of them goes below the minimum balance, you don't need somebody to watch that and manually move funds over. You can automatically move money in liquidity pool. So there are all these options that are emerging. We did some transactions with a shipping company and a canal operator, and historically they would use letters of credit to process canal services. we took our tokens and programmed that condition in there that when a ship passed through the canal, you didn't need to process the paperwork anymore. All you need to do was update the system electronically that the conditions of the passage had been satisfied, and the token released money immediately. So you are already seeing things like this pop up and be adopted in scale. But to go back to what Jennifer said earlier, it's very important to have the right risk and control and a regulatory framework, because I often joke with my friends who are in the tech industry, when you are in dealing with money, and that to somebody else's money, you have a fiduciary responsibility, and they expect 100% performance. You cannot operate with 2%, 3% error rates, because that really takes out the faith in the financial system and then starts creating these runs and these other kind of issues. So that will always be a point, as much as we innovate, add efficiencies, add AI, and the blockchain ecosystem natively is digital data. So it's very, very prime to be used for rules and AI based. But I think you still have to keep a focus on the risk and control aspect.
You may know the number off the top of your head, but I've heard the number of how much money Citi moves every day. It's a lot.
So we process about, close to $3 trillion on a daily basis, as do most of the other large banks.
Yeah.
So when you look at that perspective and you look at the crypto economies, you're starting to see crypto assets away from coins trade about 18 to 20 trillion a year. You're starting to see stable coins trade about 25 to 30 trillion a year. So they are growing in size, but they're still not up to the scale that traditional banks typically handle for the financial ecosystem. Yeah. But we're getting there.
Jen.
Yeah. Okay, so I'm going to start super optimistic, and I'm going to say if we get the rails and the guardrails accordingly right, which means trusted system, safe system, which includes bank participation. And I think that sometimes there's a thought that banks don't want to participate in the crypto environment. I think the disruption to the business model is welcome, and there's an important role for banks to play. If we get that right, the upside is massive, right? Because remember in the beginning when I was saying we're changing, it's not just a user interface change, it's the infrastructure change that's happening. And the example I like to provide, again, emerging markets background, but is if money is the same as data in this future, and we can move data seamlessly whenever we want across borders, we should be able to do the same with money. If you take remittances, cross-border remittances as an example, and you're a migrant worker in the US and you want to send money back to your family, imagine being able to send it and have your family receive it on the same day, and maybe that cost is like $5 as opposed to what it is now, which can be exorbitant dependent on which remittance vendor that you're using. That's life-changing for that individual. It is quite impactful for the local economy where the money is going back to. But one of the things I wanted to touch on that I think is really important that Biz was bringing up is that actually the future is plural. So there is not any world, I think I'll say in my generation, if I were a betting gal, where I'm going to wake up and I'm going to have, sorry for any Bitcoin maxis in the audience, I'm going to be like grocery shopping with my Bitcoin. It's going to take a while, like a long while, a couple decades for any type of global systemic change to that extent for digital assets where it has tipped over, I think, the traditional financial rails. For most of my lifetime, I will assume that both of these things will coexist, and there will not be kind of like one stablecoin to take them all, or one, Bitcoin for everyone, no Ethereum. It's going to be a mix of all of these things, including tokenized bank deposits and tokenized real-world assets. So I think we live in this melting pot for a while, but what that allows is for what you need in your regional location with your regulation that allows you to do certain things and not others. There's actually solutions where you can get the benefits of the technology through different types of assets. And that's what's
just about out of time.
Yeah, sorry to
that's okay. I do want to say that you touched on the emerging markets point earlier. My organization, nonprofit, is doing a project in Africa where we do expect to see retail use cases where people need money that's stable, raises a lot of complicated issues, including dollarization of these economies and so on. In the US, where most of us are not expecting retail stablecoins in the short term, but maybe eventually. And I was going to ask you each for a closing statement, but we are out of time. So please join me in thanking our panel.